All right, we are 2 minutes after the hour. It makes sense to get started. My name is Ryan. I lead the offshore wind commercial team within Esgian Offshore Wind. I do see clients that have logged on. I see many names that are recognized, but also many new names. So first and foremost, thank you all for attending today. I also see some names that we met in person at Wind Europe in Copenhagen the other week. So just want to emphasize that it's always great to see you in person. Those conversations are much appreciated. But for those of you that do not know, Esgian, we're headquartered in Oslo, Norway. We're a market intelligence and data analysis firm for the ocean industries, operating in three main verticals. That's offshore rigs, shipping, and offshore wind. My focus being 100% offshore wind, and obviously today we speak on offshore wind. And also, some of you know that each month we do host this monthly webinar that covers a current and relevant offshore wind topic. We do keep these to 19 minutes, and we do that purposefully. We do understand everyone's time is precious, and we want to provide you with the highest quality information in the shortest period of time possible. And if you haven't already, I do encourage you to sign up and follow us on Esgian Offshore Wind on LinkedIn, and sign up for our newsletter to be kept up to date on all future events, news, and receive our quarterly reports. Recently, we have released on our website a free interactive offshore wind map. I do encourage everyone to check that out. Simply go to www.esgian.com and click on the wind section. At the end of the presentation, there will be a QR code where you can scan that, and it'll take you right to the free interactive map. Within Esgian Offshore Wind, we do offer an award-winning subscription-based digital platform that provides transparency and clarity into the global offshore wind market. Our clients are developers, companies within the supply chain, vessel operators, consultancies, and more. And we're primarily helping them with business development, competitive analysis, and also strategic planning with data that is in near real time. We're actually updating the platform on average 50 times per day. And in addition to our wind analytics database, we've recently released a new and separate tool that sits on top of the wind analytics platform. This tool monitors and quantifies the power generation of operational wind farms globally, allowing one to benchmark and compare against different performance against projects, geographies, operators, turbine models, and so on. And this feature is primarily being used by investors, insurers, developers, and utility firms. But the purpose of today is to go through the 19-minute webinar, and today's topic is our Q1 offshore wind market update, where we will provide a few of the highlights from our quarterly report that was recently published. It tends to be a favorite topic, and I hope that everyone enjoys today. I do want to emphasize that during all of these webinars, the analysis and information covered is done by our team of analysts through our digital database. Today, we've got Kasper and Oliver joining us, going through the meat of the discussion. And with that being said, I want to hand it off to Kasper. So Kasper, why don't you take it away?
Thank you, Ryan. We move over to our first topic of the day, our offshore wind pipeline for Q1. This slide shows the global offshore wind pipeline with all capacity scheduled to be awarded, confirmed under installation and operational. So then showing the amount of capacity built and what we can expect built at some point in the future. For Q1 25, we saw a quarter-on-quarter increase of 2.3% for the total pipeline, driven mostly by new projects confirmed in China, with very little new additions in Europe and Asia Pacific. The Q1 growth is lower than an average over the last years, but in line with the trend the last 4 quarters, reflecting the market uncertainty we have seen since late 2023. We also see in the Q1 numbers a continued trend of conversion from lease areas to confirmed projects now owned by a developer, and more capacity under installation, both of which are good signs for the industry. Looking a bit ahead to 2030, for the same set of data, we expect an average growth of the pipeline between 1 to 2% per quarter, much fueled by China, but also more projects being confirmed in the likes of South Korea and some new lease areas added in Europe as well. We also expect a continued decline in the share of lease areas on offer compared to the total pipeline, as demand for new lease areas is low and fewer new ones are being announced. So what does this all mean? We expect fewer new sites awarded to the developers, but a more maturing pipeline with more focus on awarded projects, converting them into operational capacity. We still see new sites being awarded, especially in the mature markets with good support schemes, but likely not at the same pace and level as the last few years. Then, zooming a bit in on the activity we have seen in Q1. First, we saw very few lease areas given out in the first quarter, a big drop from the end of last year. But as we see in the top chart to the right on the screen, there is a lot of capacity scheduled to be awarded later this year, weighted to Q3 and Q4. We can note here, though, that we don't expect all the capacity to be awarded, based on the trend that developers are holding back a bit on taking on new sites, and most of the capacity on offer is in markets with less robust and established support schemes like Finland, India, and Australia. Q1 saw a small increase in vessel contracts announced, with the majority being cable installation contracts, but also new contracts for Havfram and Cavalier. Activity is picking up for the year, with contracts starting on sites like Sofia and Baltic Power, with more expected going forward. Q1 also saw a healthy number of new supply chain contracts, but not matching the typical end-of-the-year rush we saw in Q4 last year. It is still the cable and transmission segment dominating the contracts, driven by TSOs planning ahead. This could be a positive sign for the turbine and foundation segment as well, as cable and transmission contracts have the longest lead times, meaning that when there are cable and transmission contracts announced, new turbine and foundation contracts are likely to follow at some point. There's also a large amount of backlog for projects to reach COD, as we see in the chart at the bottom right. But we do expect a healthy amount to be added towards the summer, with many of these having been rolled over from late last year. We are seeing projects taking longer to reach COD, naturally because they are larger, but also because there are some maintenance needed early on for some projects. For maintenance hours in Q1, we saw a slight drop compared to last year. We do, however, see this segment to increase a lot in the coming years, as there are more projects and turbines to be serviced. For our forecast for maintenance going forward and what turbines and projects we see are getting serviced, please reach out after the webinar. And with that, I give the word over to Oliver.
Okay, so after Casper's just run through a lot of detail there around many of the different things that we're tracking in the quarterly report, I'm going to touch on a little bit now around what we're seeing in the US. There is so much to say about offshore wind in the US. It's clearly a very dynamic situation, and it's worth highlighting that this is one of the most frequent questions that we're continually being asked about by our clients. So we thought it might be helpful to condense some of our latest thoughts onto this one slide. We did also manage to squeeze a few of those thoughts into the Q1 quarterly report that we published a couple of weeks ago, just before the Copenhagen event. That was just as tariff levels were being announced by the Trump administration, just as we're in the final stages of the editing process of that report. So there is some commentary in there. However, such is the current nature of the US market that those comments have somewhat been overtaken by events already just a couple of days later. So let's start with tariffs, and then we'll look at some very recent project-specific events. For tariffs, our feeling at the moment is that the wider impact is likely to be quite limited. We think it's likely to be very significant for just a few projects and therefore just a few developers, but on the whole, offshore wind looks like it's going to get off quite lightly, particularly when compared with many other sectors of the global economy. However, having said that, context is important, and it's worth remembering that US projects were already at something of a standstill almost immediately after the election in November 2024. And it's also worth remembering that despite huge expectations of growth that we previously held, the US remains a relatively small part of the global offshore wind market. If we then turn to imports into the USA, a select number of developers that are still trying to install and build in the States are likely to be affected from higher prices for materials landing into the US. But we think most developers are going to be insulated, but where it does hit those few developers, it will hit them very hard indeed. The other aspect here is to think of exports coming out of the US. There are very few US factories exporting to the rest of the world for offshore wind. So we think that if any reciprocal tariffs are put in place targeting exports out of America, then again, there should only be very marginal implications. Perhaps with a bigger impact and certainly more recent in terms of reciprocal behavior, in the last couple of days, we've seen restrictions being imposed on exports from China around certain rare earths. And this is potentially going to cause significant issues around the supply of some of those materials of particular importance for offshore wind. Obviously, it's dysprosium and particularly neodymium to watch, which are integral to the permanent magnets in the turbine units. The situation there is far from clear, and we really are waiting for updates to see what impact that is likely to have. So very, very confused. Looking longer term, beyond these short-term thoughts, any US downturn or recession that might well lead to a slowdown in capex by offshore wind developers in the rest of the world. And any US-led recession that does lead to a global downturn is then likely to have wider impact on electricity demand. But again, here, the caveat is that offshore wind projects have a plus 25-year, 30-year operational time frame and are somewhat immune to these short-term fluctuations. And then looking to the very longer term horizon, if anything, we feel that events in the last month or so are likely to reinforce calls for greater energy independence, which should then be supportive for offshore wind. So that's where we are at tariffs right now, although I would stress that it is a changing picture quite rapidly at the moment. But if we move away from tariffs specifically and look at last week's news around Empire Wind and the subsequent halt to construction the next day, our view at the moment is that this suggests that anything is now possible. Let's backtrack a little bit here. Our working assumption had been that US projects with full permitting would have been able to proceed through the construction phase. That slight sense of optimism now looks pretty misplaced. The easy way to say this is that the news on Empire Wind 1 was worse than our worst case scenario. Sorry, jumping ahead too soon. So if that's worse than our worst case scenario, what are we now thinking? Well, our current view is that projects that are installing, so we're looking at Coastal Virginia, Vineyard, Revolution, those projects are likely to continue. Projects that are just about to begin installation, so Sunrise and Empire Wind, now look at considerably higher risk. We previously felt that these projects would proceed according to schedule. It's worth pointing out, if you are looking at our database, if you are one of our clients and looking at the data, we have still retained vessel contracts and dates for those projects until we get a better understanding of vessel movements. But we're really on top and keeping a close eye on what that might mean on the granular level. But there's clearly now a much higher risk than before on those two projects in particular. Beyond those projects that I just mentioned, we haven't really changed our view since the election took place at the end of last year. Our rather negative outlook has always been that it seems very unlikely that any other US project will move forward in a meaningful way for at least 3.5 or 4 years. Worth also mentioning that we have removed all dates in the database from the BOEM announced lease rounds in the future on the basis that we don't expect them to proceed in the current administration, but there has as yet been no official cancellation of those lease rounds. Okay, changing subjects once again, another of our key messages from the last quarterly report, moving through these top 5 themes to watch. As a reminder, this year, as Ryan mentioned, we've introduced a new module on power generation, the power that's being generated from offshore wind. And again, this is a very dynamic part of the market. And after all, it's the end goal of all of the development that we spend a lot of time discussing with you is to actually generate power from offshore wind. One of the key trends that we've seen in the power generation side of things over the last few months has been that wind speeds in the South China Sea were exceptionally strong in Q1 2025, and that led to very high capacity factors at Taiwanese offshore wind projects. The average capacity factor in the region was just over 55%. It's clear that the offshore wind sector in Taiwan has been under pressure in the last couple of years with regard to local content obligations, uncertainty around lease rounds. But it's pretty clear to us now that the wind resource is proving itself. The data that we're seeing shows really very, very strong performance from those projects that are operational. So let's give you a couple of numbers to highlight what we're seeing in Taiwan to quantify this. Taiwan accounted for 4 of the top 5 projects that we were tracking. And we're looking globally across 83 different operational assets, so accounting for 4 of the top 5 in the first quarter of the year. Ørsted's project, Greater Changhua 1 and 2A, was the most efficient project during that quarter, and that was able to reach a capacity factor of just over 68%, followed by Formosa 2 at just about 62%. So those were the 2 best performing assets that we're tracking globally. For comparison, there's 68 and 62% there. For comparison, Ørsted's Anholt project in Denmark was the best performing asset outside Taiwan, and that reached just about 52% capacity factor. So a significant difference there between those projects. As you can see on this chart on this slide, Taiwanese projects have had really quite lengthy commissioning phases. This is something that Casper also mentioned more broadly, with turbines being brought online often well in advance of the official COD date for these projects. In practical terms, this means that we're already receiving generation data from a number of projects that have not yet been officially connected in terms of all units to the grid. There are an additional 3 projects, which is just over 1.2 gigawatts of new capacity, which we expect to reach COD by the end of the current quarter in June 2025. Early signs from these projects, we're looking at Yunlin and the 2 phases of Changfang Shidao, are looking very positive. They're already generating significant power and contributing significant cash flow to those developers. And that's well in advance of the official start dates of those projects. So with that, let me pass it back to Casper to round things up with our broader outlook and analysis.
Thank you very much. And for our last slide, the market outlook for offshore wind towards 2030. There are some key trends we're seeing affecting the outlook. We clearly see interest in new sites dropping and rounds struggling to remain competitive. After several years with large lease rounds, the willingness to take on new projects without a support scheme is low. To address this, the Dutch and Danish authorities are looking to bring back subsidies for future rounds, going back on their previous no support policy. Markets with big plans and no solid support schemes could find it difficult to attract top-tier developers if other countries sweeten the deal. Power demand could also affect the industry if we see a lowering of the projected power demand for the coming years. As already mentioned, given the somewhat turbulent economic policies out of the US, the outlook for global economic growth and power demand could be adjusted down. The next couple of years could also see more transaction activity for offshore wind in markets such as the UK, Germany, and Poland, as developers are looking to offset capacity for maturing large-scale projects. Extensive farm-down plans from the likes of RWE and Ørsted are now being executed, including for big-ticket projects like Hornsea 3 and Norfolk. This could lower demand for new sites, and industry players opt for partnerships instead of taking on new ventures on their own. So for our outlook for operational capacity towards 2030, there have been some slight downward adjustments since our last update in Q4 last year. For potential operational capacity, the light green line on the chart on your screen, we have seen additional proposed projects push their CODs after 2030, therefore lowering the 2030 numbers somewhat. For our own expected operational capacity for 2030, the dark line on your screen, and it's the halt in the US confirmed projects that has led to a slight lowering of the expected operational capacity by the end of the decade to a total of around 148 gigawatts. And with that, I give the word back to Ryan to round things off.
Excellent. Thank you, Casper. Thank you, Oliver, specifically for your insights and analysis. It's always much appreciated. If you do have questions, please type them into the Q&A section, and we can address them. But while we're waiting for questions, you can see the QR codes right there. We have a QR code for our mailing list, the interactive map. I also put the link in the Q&A section to the interactive map for you to view as well. So with that being said, let's see if there's any questions. I don't see any yet. But I do hope that everyone found this discussion. We do our very best to keep it to 19 minutes. It's a little bit over, but hopefully everyone did find it beneficial and efficient. That is the ultimate goal. Thank you very much for attending. We hope to see you on next month's webinar, and I hope everyone has a great day. Thank you.
Thanks. Bye.